President Trump has told the Fed to cut rates, but will it listen? Welcome to Macro Matters, your look at what's moving the global economy. I'm Elena Casas. The Federal Reserve sets rates on Wednesday. This week, Donald Trump said he wanted them to cut the cost of borrowing immediately, but markets expect they won't budge until perhaps May. Odetta Kushi is Deputy Chief Economist at First American. Odetta, what are you expecting?
I'm aligned with the markets on this one. I'm not expecting the Fed to cut rates next week, and I think we could probably see the first rate cut in the second half of the year. The Fed themselves told us they're only expecting about 225 basis point cuts this year, and that's really a function of our current macro environment.
As recently as September, Odetta, the Fed's own projections predicted a whole percentage point of rate cuts this year. What changed?
It's been a more robust economic environment. Economic growth has exceeded our expectations. Inflation has made progress towards the Fed's 2% target, but towards the end of the year, that progress has stalled a little bit. So we've seen inflation remain stickier than anticipated. And the labor market, of course, has outperformed expectations. We saw very robust growth in the labor force in December. And so as a result of that, the Fed's not seeing the labor weakening that they thought would happen in September. Economic growth has been robust, and so they're saying we feel comfortable pausing.
Do you think a resurgence of inflation may make the Fed's job even more difficult this year?
If we were to see a resurgence in inflation, I think that would make the Fed reconsider rate cuts. But at this point, there are still enough disinflationary forces in the near term. So I think they'll take a wait and see approach and wait for incoming data to see how we're progressing on both of their mandates, both the labor side and inflation.
For American consumers trying to get a mortgage, though, it's not just the Fed funds rate that matters, is it? Mortgage rates follow Treasury yields, which have risen even as the Fed has cut. So what does that tightening of credit mean?
That's exactly right, which is very unusual compared to historical norms, that when the Fed cuts, we see an increase in the 10-year Treasury yield, but that's exactly what's happened. And for mortgage rates, that means mortgage rates cross the 7% threshold again. And that's really an issue for potential home buyers and the housing market at large, because the average interest rate on an outstanding mortgage is about 4.2%. So with rates at 7%, those existing homeowners, they're not incentivized to sell. And that keeps inventory off the market, and I think will really keep the pace of sales limited this year. With that said, we have seen inventory increase a little bit, and that's allowed for some more sales activities. So this year will be another challenging year for the housing market.
Do you expect it to remain stagnant throughout 2025?
We might see a little bit of progress if rates come down by the end of the year. The general consensus is that we'll see rates slide down a little bit by the end of the year as we get a little more certainty about monetary policy, but we still anticipate rates to remain above 6%, which means a lot of those existing homeowners will still be rate locked into their homes. And so maybe we see a little bit of an increase in purchase activity, but not that much because of that rate lock-in effect.
Odetta Kushi of First American, thank you so much. That's Macro Matters. Don't forget, you can watch more videos on Reuters.com.